Hello, clients, friends, and colleagues. This is Rich Siegel with ARQ Wealth Advisors, and today is Sunday. Hope everyone is doing well. Well, it's time for another market update. We're going to quickly run through some slides, and you can see here that we have a three-item agenda today. First, we'll discuss inflation and the Fed. The second item will be the market pullback, and then third, some market and economic data. So let's get right into it. All right, first and foremost, you can see here that the latest consumer price index, that's inflation, reading on Friday was a whopping 8.6%. The market did not like that. That came in about 0.3 above the consensus estimates, and therefore the market was down on Friday 880 points. You can see here from this chart that CPI is 8.6, and then down here is CPI minus food and energy. Food and energy are actually the items that everyone is kind of feeling now in their wallets. So we don't want to leave that out, but that's just another measure of inflation. Down here is a matrix from the Bureau of Labor Statistics. You can kind of see here I highlighted energy over the last year is up 34.6%. Gas at the pump up 106%. And food items in aggregate up 10%. So this is really what we're all mostly feeling right now. A lot of this has to do with the excess supply of M2, which is cash in the system that was created during the pandemic, and then also supply chain issues. I know that there's been lots of discussion about peak inflation. It seems to be peaking in this range here. Over the summer, the driving months, that's typically when oil spikes anyway. So hopefully we're just a couple of months away from peak inflation and some type of relief at the pump. The Fed funds rate, that's the rate that the Fed, the FOMC controls, is currently at 0.75%. It was at zero for the last couple of years, and we have a meeting this week. It's going to be announced on Wednesday. Consensus is 50 basis points, 0.5% for June and July. So by the end of July, you'll probably see the Fed funds rate closer to 1.75. I would not be surprised to see a more hawkish Fed, meaning that they're going to get more aggressive to really try to fight down this inflation. I would not be surprised to see 0.75 this week. That might be what's needed. Now, raising rates, the point of raising rates is to slow down demand. When rates are higher, folks won't buy as many cars or homes or boats or small business loans, so demand will shrink. And if demand shrinks, then prices in turn will fall. That's the playbook of monetary policy to fight inflation. Raise rates, and then when you go into a recession, then you lower rates. All right, market pullback here. It's been pretty ugly this year. You can see year to date through Friday. The best performer is foreign stocks. So this color here, this grayish color, down 14.82%. That's the entire global stock market without the U.S. market, down 14.8. The S&P index is down 17.6. The NASDAQ, tech-heavy NASDAQ, is down 27.5. And the FANG stocks, I put FANG plus T, so Facebook, Apple, Amazon, Netflix, Google, plus Tesla, down 38.5%. So those are the stocks that did really, really well for many years, and now they're paying the price. When things have outsized returns, typically they have outsized losses, and that's what's happening there. What's really fascinating is the difference in performance between growth and value stocks. So this year, growth, that would be consumer discretionary. Think things like Netflix or cruise ships, Peloton, things you don't need but you want. So that's discretionary. And technology. That's mostly what growth is, down a whopping 37%. And value, which would be more like old economy, You could think financials, utilities, industrial companies, energy, only down 4%. As a firm, we started moving money out of growth into value about a year ago, maybe a year and a half ago, too early. But we're a little bit biased now towards value, and that's prevented us from having any serious blow-ups with client portfolio balances. Bonds also have been tough this year. In fact, I'll show you in a moment. Bonds have the worst ever start to a year ever. So you can see here that the U.S. aggregate index is down about 10.6, global bonds down 13.6, U.S. Investment grade corporate debt down 13.8, and long-term U.S. Treasuries down 23%. So bonds have really taken it on the chin. Rising rates up, bonds down, and rates down, bonds up. We plan for this somewhat. Our clients' bonds this year are down between 6 and 7%. There's been nowhere to hide. However, being in shorter duration bonds and then some alternatives has helped us to not take the full brunt of the historical pullback. These two charts are really cool. These are from Blackrock, and these are a little stale. They're a month old, but I want to just kind of share some of the data here. This over here on the left is the third worst ever start to a stock market year through April. Does not include May, so it's going to be a lot worse. In fact, when the new one comes out, this might be the second worst. But long story short, what we're saying is here, the worst 10 ever, the average is minus 12.2 for 4 months. And when that happens, on average, the next 8 months, the market's up 14%, and the next 12 months up 25%. So things don't go down in a straight line. They don't go down forever. When things go down this much, they get cheap and attractive, and then usually the next 12 months is pretty good. So that's what we're thinking will happen at some point. It's only one time ever, 2 times ever in history where the next 12 months it was down 12% more and 11% more in the 40s and the 70s here. Now, on the bond side, pretty similar. This is the worst ever start to a bond year. The second worst was in 94, only down 3.6. So this is really unprecedented. And then you can see here again over the next 8 months up 5 and then 7 for a year. So usually when things have outsized losses, they have outsized returns in the next year or so. As far as market and economic data, pretty shocking here. The University of Michigan Consumer Sentiment Index came out on Friday, and this has been around for 60, 70 years, this metric. And shockingly, this is the lowest consumer sentiment reading in the history of the benchmark. And what's really fascinating is even worse than the great financial crisis, when literally the banking system was on the edge of complete collapse, and also worse than the pandemic. So people are really kind of negative on our policymakers. They're negative on the inflationary environment, and they're afraid that we're going to go into a recession. And the good thing is, when people are this negative, this is a chart going back 50 years, and these blue dots down here, these inflection points show that when you have extreme sentiment, and this was May, now we're down here. So this is the lowest ever now. When you have these extreme periods of pessimism, the next move in the market is usually up. So you can see here in 2011, up 15% from this point. 2008, up 22%. 1990, up 29%. So usually when it's counterintuitive, but when things are quite negative, the market tends to do well on a go-forward basis. A couple of metrics here that bear looking at. Number one is the S&P 500, the benchmark U.S. stock market index, is currently trading in the 16.4 times earnings range. Over the last 25 years, the average is 16.85. So we are definitely fairly valued, meaning the market is It's no longer expensive relative to history, but, okay, I'll say but, if inflation persists at these high levels, we're probably going to see the PE ratio come down lower into the 14 to 15 range. So it's really kind of a race against time. We really need to see inflation peak and start to roll over for the market to really turn around and do well. Now, growth stocks are still at 23.5 times earnings. They're usually around 20 or 21. And value stocks are trading at 14.5. So value stocks remain a pretty good value here. Small cap stocks are trading at 11.5. Foreign developed, that would be Canada, Europe, Australia, Japan, 12.5, and emerging markets 11.3. So lots of value, lots of bargains in the smaller cap space, the value space, and the overseas space. Finally, there's been a lot of talk about recession. We think that the market is actually already pricing in a shallow recession, has already priced in a shallow recession. I just heard an analyst over the weekend talk about in shallow recessions, the average loss in the S&P 500 is about 24% down. From peak to trough, the S&P is down about 19% right now. So we think it's really mostly priced in. Okay, and what's also interesting is when you have periods of recession, these red lines, these vertical lines here, you see unemployment spiking up. Well, we're at 3.6% right now, unemployment. That's not a typical recessionary type of metric here. So we're probably looking at a 30 to 40% chance of a recession in the next 12 to 18 months. We think that most of that is already priced into the markets. The Fed will be raising rates, so they'll have lots of tools in their toolbox to lower rates if we go into recession. They'll lower rates, which will really make bonds go straight up. So things are a little precarious right now. We're managing around these risks. We feel that being diversified, being low cost, being tax efficient is the winning strategy today. Overweighting in value and having exposure to foreign and small cap stocks has delivered some protection to the downside. And we think that at some point we'll see a pretty big rally here. Things don't go down every week, and things are pretty oversold at this point. So with that, we'll end here. Have a great weekend, and we'll speak to you soon.